In recent years, inflation and interest rates have been key economic topics. Understanding their relationship can aid in your personal financial planning. First, inflation is when prices increase over time, and interest is the amount a lender charges a borrower. An interest rate is a percentage that is used to determine how much interest a borrower is charged. The federal funds rate, set by the Federal Reserve, heavily influences interest rates. This is the rate at which banks lend to each other overnight. When the federal funds rate is low, borrowing money is cheaper, stimulating economic activity. A high federal funds rate makes borrowing more expensive, slowing down the economy. The Federal Reserve adjusts this rate to stabilize the economy during periods of expansion and contraction. The last few years have essentially been a case study for these principles in action. During the pandemic in March 2020, the Federal Reserve lowered the federal funds rate to nearly 0% to combat the contraction that was expected due to lockdowns. This cheap borrowing cost spurred consumer spending, notably increasing home sales. However, the influx of money into the economy contributed to high inflation from 2021 onwards, reflected in rising home, grocery, and car prices. To curb this, the Federal Reserve began raising the federal fund rates in March 2022, which made borrowing more expensive and has helped reduce inflation. Inflation and interest rates are very closely related in our economy. Having a grasp of their relationship and paying attention to economic news can help you make your own predictions on where the economy is heading and how it will affect you personally.